team has actually created, some scatter plots for each of the commodities to see which commodities react in what ways to the different factors. So there's a range of factors affecting commodities, right? Of course, growth and inflation, demand and supply, weather, the strength of the dollar, geopolitics, as we can see in the current environment. So which factor affects which commodity more? You can see those in those scatter plots. So that's really interesting.
Hi everyone, and welcome to the Curious Investor, Saxo's video series where we dive into the topics which are driving the investment markets. My name is Fiona, and today I have with us Charu, Chanana, our market strategist here in the Singapore office. And currently it's in October of 2023. So we've been covering about our quarterly outlook, and in the past 2 episodes mainly about bonds as well as FX. So today we'll be covering more on commodities, which I think has been a really interesting sector to watch right now.
Yeah, absolutely. Saxo has been overweight on commodities for quite some time now, but last few months and actually the whole of last year was quite tough as well because of the rate hike cycle that was going on in the US and globally as well. But now we are entering that phase where the peak rates narrative is taking over, and just now the third quarter of 2023 we finally saw a positive performance in the Bloomberg commodity index as well. So certainly it's looking like it's going to be a space to watch.
And oil and gold is definitely something that a lot of people have been looking at and discussing this year. And even for our Saxo clients, a lot of them actually do hold positions in oil and gold. So for crude oil, it has gone up more than 8% this year, mainly because of the Saudi supply cuts of more than 1 million barrels per day of supply to the end of this year. So there seems to be, there are some talks about whether the oil is going to go up to more than $100 per barrel. Yeah, what's your thoughts on that? Do you think it will really reach that price?
So absolutely. Oil and gold are, the commodities which get a lot of interest from our clients particularly. But just stepping back a little bit, I think I would really want to highlight that on the Saxo platform on the research page, our team has actually created, some scatter plots for each of the commodities to see which commodities react in what ways to the different factors. So there's a range of factors affecting commodities, right? Of course, growth and inflation, demand and supply, weather, the strength of the dollar, geopolitics, as we can see in the current environment. So which factor affects which commodity more? You can see those in those scatter plots. So that's really interesting, and I would want to encourage commodity traders to go and have a look there. But yeah, coming back to your question on oil. So certainly I think the biggest factors for oil remain to be supply and demand. And as you mentioned that Saudi cuts have been driving the price action in oil for some time, although we do think that the motive of Saudi Arabia is really to kind of support prices. They still have a lot of spare capacity. So in the event that we do see this current unfortunate conflict that's going on in the Middle East region spiraling out of control, and that obviously spooks fears of higher oil prices, then I think Saudi Arabia and other GCC members still have spare capacity. They can bring up production and they can obviously control the prices there. But at the same time, like you said, there's this macro conditions as well that is affecting the oil prices right now. The biggest consumer for oil are US and China, and we are seeing demand being really weak in both of those places. China has remained weak for quite some time. And in the US, we've talked about our outlook in several episodes now. We are looking at the US consumer starting to lose momentum from here on, going into, now that we are into the fourth quarter and going into the next year as well. So lack of demand from both US and China could underpin lower oil prices. But again, Saudi Arabia does not want to see too low prices as well. So we are looking at oil being a little bit more range bound because of those reasons. So maybe around the mid 80s to the mid 90s kind of range. But of course, it's hard to say where geopolitics goes from here. So that's really the wild card in oil prices. There could be a short-term spike to $100, like you raised the risk there. But from a demand supply perspective, we don't see that $100 or more kind of a price level to be sustainable in oil.
Yes, so let's jump to gold. I think currently right now with the conflict in Israel, there has been some or more safe haven demand in gold. And on top of that, even with the recession concerns, it does seem that gold is a good hedge in this market environment. However, it does look as well that it's been quite choppy in terms of the price movements. So why do you think that's so?
So certainly for gold, I think one of the big drivers is, like you said, right, it's a bid to safety that drives returns and goals. But you have to compare between treasuries and gold. And when treasuries are offering you a high yield, most investors tend to choose that. And that's why you say that there is an inverse correlation between yields and the price of gold. So I think that's obviously been one key driver. We usually look at real yields because we want to take inflation into account as well. And if real yields are too high, like they are right now, as I said, now investors are obviously flocking into bonds to kind of capture in those high yields, as we've discussed in our previous episodes, and also as a as a hedge to their equity portfolios, which are risk assets, which usually don't do well in a high real rate environment because there'll be fallouts for consumers and for businesses from those high real rates as well. So I think that's been one big driver, certainly. But recession concerns are picking up, and we've discussed that over and over again. And of course, the geopolitical situation also is adding a war premium or a safety bid as well to gold. So while those factors are still in play, I mean, we've been again bullish on gold for quite some time, but it has to be a very patience game because even now, Fed is still in higher for longer. So as long as the Fed continues to say that, unless we see that pivot from the Fed from rate hikes to rate cuts, really, the run higher in gold may have to wait for that. So we do think that gold is going to go to a fresh record high, but the timing of that is really uncertain. It depends on when that Fed pivot really comes. But yeah, I think it's for gold, I think it's really just about a game of patience.
Yes, indeed. And our head of commodity strategy, Ole Hansen, he has also been, talking about how we should all be more patiently bullish on gold, or rather that's his view on gold right now. So for those that see the opportunity to go in, especially buying on dips at 1,800, that might be quite a good opportunity. Or those who are already holding on to gold, it might be a good choice to even hold on to it for a while more.
Absolutely.
Yeah, and our outrageous predictions last year also highlighted how gold might go up to $3,000.
Yeah, absolutely.
Yeah, so let's see how it goes.
I mean, that was outrageous, but we still look at gold printing a new fresh record high in the months to come.
Yep, definitely one to watch.
Yeah.
Yes, so now that we've covered a bit more about crude oil as well as gold, how about copper? So I think there's been quite a bit of talk as well about how it's the king of green metals, and the demand and push for electrification has also supported the movement in copper. So what's your thoughts about that?
So copper is actually a very different story if you look at it short term versus long term. So short term, copper has obviously been hit because of the China's property sector concerns, and then of course also again the recession concerns. Copper is actually called Dr. Copper for a reason. It actually shows the health of the global economy. So like we talked about the high positive real rates and the fallouts from that for businesses, and particularly that will be applicable for real estate, who are largely dependent on borrowings, right? So real estate, if real estate gets hit, if construction sector gets hit, that means the demand for copper could stay subdued. So that's what is really affecting the short-term price movements in copper. If we do see a recovery in China, obviously we could get a bid in copper as well. But so far, any stimulus announcements or any high-frequency data from China, the improvements there have been rather limited to bring about a sustainable bounce there. But at the same time, copper has been quite supported despite the recession concerns, despite all the China problems as well. And that's because the long-term view is really about the amount of copper that is needed for electrification. So just if you consider an electric vehicle battery, a huge part of that is obviously coming from copper and some of the other green metals as well. But everywhere you see, grids and whatever you need to do that electrification and decarbonization, you would need copper there. So that's the long-term demand story. And again, if you look at it from a supply perspective, that's not looking very very healthy. Copper supply has been, the ores in copper, they are having lower ore grades. There's been, climate change from flooding to droughts that's affecting that. There's obviously a lot of government regulation, a lot of intervention that goes in there as well. So we have seen that exchange monitored stocks for some of these green metals, they are at multi-year lows. So there's not enough supply, and demand is going to accelerate at a very rapid pace once we move away from recession concerns, and the cost of capital is really more favorable to continue with these projects on electrification as well. So the demand side, the long-term story, I would say, looks quite optimistic. But in the near term, there are still some risks in the path ahead for copper.
Yeah, quite a few factors to think about.
Yeah.
Yes, but I think as you mentioned, long-term structurally, there's still a lot of potential for copper, especially with electrification demand. Yes, so and I think also with the Fed starting to cut rates towards hopefully next year. Yeah, and then there'll be much more potential for copper to rally as well.
Yeah, absolutely. Once we see that Fed pivot, I think that will be quite a big turning point for commodities in general. And yeah, some of these more economic growth dependent commodities like copper.
Yeah, and it's great that on the Saxo platform, you do have many instruments that allows you to express your views, whether it's crude oil or gold or copper. And in this case, for copper, there are equities that allows you to invest into the copper companies, or even ETFs that allow you to invest into, diversified instruments that it goes into the copper mining companies. So a lot of opportunities there and to explore. Yes, so before we wrap up for today's episode, maybe you can also shed a bit of light on agricultural commodities.
Yeah, I think the key thing to watch for agricultural commodities would be really the weather developments. I mean, we've seen concerns around El Nino developing this year, and that leads to disruptions in supplies. And, if at all, at least we've seen a lot of Asian countries announcing curbs to supplies of key food grains like wheat and rice. And so those risks obviously remain in the agricultural sector, and those will really determine the price action from here.
Yeah, so I think many, many good points today that we've covered, mostly about the oil price volatility that can be expected, as well as opportunities in gold and copper. So all these instruments, we do actually provide them on the Saxo platform. And if you like this video, please give us a subscription, as well as give us a thumbs up for this video. And we'll see you in the next episode.